In 2026, the term passive income has become the ultimate psychological pacifier for the shrinking middle class. We are currently being drowned in a sea of content telling us that the secret to freedom is building a dividend portfolio, that if you just buy enough shares of a blue-chip utility company or a consumer staples giant, you can live off the distributions and never work a day in your life again. It is the modern-day equivalent of the alchemist's dream, turning leaden labor into golden leisure. But here's the cold, hard truth the financial influencers and brokerage firms don't want you to see. For 99% of the population, dividend investing is a mathematical dead end that actually slows down your path to real wealth. You are being sold a slow-motion wealth drain disguised as a safety net. Today, I am going to prove to you with brutal arithmetic that living off dividends is a structural impossibility for the average earner, and how the system uses the dividend trap to keep your capital inefficient, taxable, and stagnant. You aren't building a money tree, you are feeding a parasite that eats your compounding potential before it ever reaches critical mass. The reason you fell for this is rooted in a psychological phenomenon known as the bird in the hand fallacy, combined with loss aversion. We are biologically wired to prefer a small, tangible reward today over a much larger theoretical reward tomorrow. When a company deposits $42 into your account as a quarterly dividend, your brain triggers a dopamine hit. You feel like you've won without working. The system exploits this by framing dividends as free money, but there is no such thing as free money in the market. Psychologically, you view dividends as an addition to your wealth, when mathematically they are a forced liquidation of your assets. You've been validated by a society that prizes income because income is taxable and income is predictable. The system was designed to keep you focused on yield because yield seekers are stationary targets. By prioritizing dividends, you are choosing to pay taxes today on money you don't even need yet, essentially giving the government a front-row seat to your wealth-building process. It is not your fault you're attracted to the idea of passive checks. You are fighting a narrative designed to make you a compliant, tax-paying consumer rather than an aggressive, growth-oriented owner. Let's look at the hidden math that the dividend aristocrat fan clubs conveniently omit. We're going to look at scenario A, the income seeker. We will call him Dividend Tobi. Tobi is 30 years old and decides he wants to be responsible. He invests $1,000 a month into a popular dividend ETF with a 4% yield. Tobi thinks he's building a fortress. After 30 years, Tobi's account shows a balance of roughly $1.1 million. He's thrilled. He is now generating $44,000 a year in passive income. He thinks he's ready to retire. But let's look at the systemic friction Tobi ignored. First, there is the tax leak. Every time Tobi received a dividend over those 30 years, he had to pay taxes on it, even if he reinvested it. In a taxable brokerage account, assuming a 15% dividend tax rate, Tobi's effective compounding rate was slashed every single year. Second, there's the growth penalty. Companies that pay high dividends usually do so because they have no better use for the cash. They aren't innovating, they are stagnating. But choosing yield over growth, Tobi missed out on the massive capital appreciation of the tech and energy sectors that were reinvesting their profits into the future. Now, let's look at scenario B, the total return truth. This is Growth Larry. Larry invests that same $1,000 a month into a low-cost, broad-market index fund that pays a negligible dividend but focuses on capital appreciation. Larry's investments grow at an average of 10% annually instead of Tobi's 7%, yield plus lower growth. Larry doesn't pay taxes on his gains because he doesn't sell. He isn't forced to liquidate his shares by a board of directors. After 30 years, Larry's account isn't worth $1.1 million. It's worth $2.2 million. Larry now has double the wealth of Tobi. If Larry wants income, he simply sells 2% of his portfolio a year. That 2% sell-off gives Larry $44,000, the same amount as Tobi, but Larry still has over $2 million left in the bank. Tobi is trapped by his yield. If the company cuts the dividend, Tobi's lifestyle collapses. Larry is sovereign. He controls his own liquidation. Tobi paid the government thousands in taxes during his working years for the privilege of receiving his own money back. Larry kept his money working in the engine of the global economy. Tobi followed the passive income dream and ended up with half the freedom. Consider the real-life case of Tobi. Tobi is 45 years old and has spent a decade building a dividend portfolio centered around legacy telecommunications and utility companies. He tells his friends he gets paid to sleep. But in 2026, the economy shifts. Interest rates remain high, and those debt-heavy utility companies start feeling the squeeze. One by one, the aristocrats Tobi trusted start cutting their dividends to shore up their balance sheets. Tobi's passive income drops by 30% in a single quarter. Because Tobi was focused on the check and not the underlying business strength, he didn't realize he was holding on to companies that were slowly dying. Tobi's portfolio value tanks along with the dividends. He is now 45 with a depreciating asset and a shrinking income stream. Tobi is a victim of yield chasing. He traded the reliability of a diversified growth engine for the illusion of a monthly check. He realized too late that a dividend is not a bond payment. It is a discretionary handout from a corporation that owes him nothing. This is the reality check. Passive income from dividends is a luxury for the already wealthy, not a strategy for the aspiring wealthy. If you have $10 million, a 3% dividend gives you $300,000 a year. That's freedom. But if you have $50,000, a 3% dividend gives you $1,500 a year. That's not freedom. That's a weekend at a mid-range hotel. By focusing on that $1,500, you are sacrificing the growth that would actually get you to the $10 million mark. To beat the system, you must adopt a total return defensive strategy. First, stop being a yield junkie. During your wealth building phase, dividends are an inefficiency. You want your money inside the companies, working to expand the business, not being kicked back to you so the IRS can take a slice. Focus on capital appreciation and share buybacks. Buybacks are the secret dividend the system doesn't talk about. They increase your ownership of the company without triggering a taxable event. Understand the tax cost ratio. If you are in a high income bracket, every dollar of dividends you receive is being taxed at your highest rate. You're essentially working for the government while you think you're working for yourself. Third, embrace voluntary liquidity. The ultimate financial power is the ability to choose when you realize your gains. When you buy a growth index, you decide when to pay taxes. When you buy a dividend stock, the company decides for you. In a world of fluctuating tax codes, the person who controls the timing of their income is the person who wins. Fourth, realize that passive is a marketing term, not a financial one. Managing a dividend portfolio to ensure the yields are safe and the companies aren't deteriorating requires significant research and time. It is a part-time job that pays less than a growth fund. The dividend trap is a scam because it exploits your fear of the market going down to keep you in safe assets that underperform the true engine of capitalism. It turns your compounding years into a taxable event. You are being sold the peace of mind of a quarterly check so you don't notice the millions of dollars in lost growth you are leaving on the table. Your brokerage account is not a vending machine, it is a furnace. You need to keep the heat inside the furnace to build the pressure required for true financial takeoff. The real winners in the 2026 economy aren't the people bragging about their dividend checks. They're the people who own the fastest growing companies in the world and haven't paid a dime in capital gains taxes in 20 years. If you want to be free, you have to be willing to look poor in terms of cash flow, while your net worth explodes in the background. The path to real wealth isn't paved by small checks. It's paved by the total ownership of the future. But the dividend trap is just one part of the psychological war for your capital. The same institutions that want you focused on yield are the ones telling you that your 401k is the only safe way to retire, while they collect management fees that eat 30% of your returns over your lifetime. If you think the passive income myth is bad, wait until you see the math on the target date fund scam that is currently harvesting the retirement of 90 million workers. Stop chasing the check. Start chasing the math. Because in a system designed to tax your income, the only way to win is to own the growth.